goes, you know how when some people hug you and shake your hand, they kind of lean the shoulder to the
comes in like
side?
this?
He comes in straight and hugs you. And he said, it is full frontal. I could not stop laughing
I respect that.
the entire lunch.
Yeah.
Oh, no, we both, to be clear, we both really love this guy. Like, it's not.
Love him.
And
I would hope so.
And he's like the only person I would say
Yeah,
I
now you
know that he can get away with it. Like, right? Like, it actually,
It's
Todd Brand, it works, and we both love it.
It's a very well-known person.
Yeah.
So,
Yeah.
so you call Rob and say
We were talking about it, and then he called our mutual friend and was like,
Did you laugh hysterically?
Yeah,
when you
yeah.
were-
I could not.
Because it resonated.
stop.
He's done it to him, too. He's tip to him, too. And we kind of, yeah.
Most people are tip to hip.
Tip to hip is okay. Tip to tip is a lot.
Does this guy also?
You can't.
No.
He's amazing.
He's amazing.
It's Michael Jordan.
No. I had
The
a great
equivalent.
joke that was not appropriate for the airwaves.
Yeah, let's not do that.
The equivalent of them.
All right, boys, you ready to rock today? Something tells me this is going to be one of the all-timers. It's in the air.
Yeah.
I don't know if it's spring. I don't know if it's you guys. Maybe a little bit of both. I've been looking forward to this all week. What about you?
All month.
All month. At
Where's
least-
home base for you?
Depends on who's asking, but mostly Florida.
Me.
The IRS.
Mostly Florida.
Oh, yeah.
Oh, sorry.
Bob, you look very smiley. You take an edible before you come on?
No, this is me,
No,
brother.
dude, he's pumped. I'm telling you. It's in the air.
All right.
Oh, he
It really is.
Remind me, wire on the right or the left?
Fire on
Thank
your
you.
left.
Thank you.
All right.
Is it smashing down my flow?
You look great. I had flow back in the day. I was a nice 18-year-old. Had some hair. Not anymore.
It's possible again these days.
No,
You
it's
have to-
not.
you have to
Josh,
go-
is it possible?
No. You have to go to Turkey. Then it's possible. It won't be your hair, though. It'll be from a dog. But you can get
You
it.
have to decide the dog?
You can get it.
All right, let's pod.
All right.
2 seconds. So what else is going on, boys?
Oh, I heard a crazy story about you.
You look nervous. You're sweating.
You were doing Closing Bell with Leslie Picker. And right before the segment, you looked up her credentials to make sure that she was up to the level to ask you why you think the market's going up or whatever she's going to ask you.
That's
And
not true.
There's no way.
It's not true.
I did look up her credentials, but that was only because I was trying to just resonate with something about her background. It wasn't to see if they were up to this.
Trying to connect
that's
for
trying to
comfort.
connect.
Sounds
Okay,
crazy. You know, the first time Adam was on, he was super duper sweaty. You
She's
remember
not
that?
she's not mad about it,
He was
but she thought it was funny.
Crazy sweaty.
You know,
I really feel bad she took it that way. I was actually
No,
impressed with her
not in a
background.
bad way.
Yeah.
She's just like, all right, am I good now?
No,
So-
she was very impressive. I've been
Yeah.
I've been on with her many times before. I just looked her up.
That is awkward.
Because
Let's
sometimes you're
start
like,
the show.
oh, you went to UCLA, you know, whatever. I was just trying to connect, you know, and I didn't prepare.
I was screwing with her on the commercial breaks. I was looking up. She was up for a Gerald Loeb Award, and I was asking the producers to verify
that?
it. No, can you please verify that Leslie was nominated for this award?
That's hilarious.
Shout to Leslie Picker.
Yeah.
Alrighty.
All right,
I hope she sees that. I genuinely
dude, she loves you.
How
All
about
in the fun.
Friends? Episode 239.
Support for this show comes from Public.com. If you're actively involved in your portfolio, you probably catch yourself repeating the same actions. Buying the dip, manually sweeping idle cash, putting on a hedge.
On Public, you can now create AI agents that handle all of these tasks on your behalf. Just describe what you want to do in plain English.
Like if the VIX hits 25, buy a put option on the S&P 500.
Or if my cash balance goes above $20,000, move the excess into my direct index. You approve the workflow, and your agent handles the rest.
Monitoring the market, watching your conditions, and executing your strategies exactly as defined, Public is the world's first agentic brokerage and investing platform driven by your intent, not just your clicks.
Oh, and P.S., you can also get full read and write access to your account via the Public API.
Go to public.com/compound and earn an uncapped 1% match when you transfer your portfolio. That's public.com/compound. Paid for by Public Investing. Brokerage services by Open to the Public Investing Inc. Member FINRA and SIPC. Advisory services by Public Advisors LLC. SEC registered advisor.
Complete disclosures available at public.com/disclosures. Oh, wow. 239. Rob, we've done this 239 times so far. Or 238, going into 239.
And this is my virgin experience.
Yeah,
I kind of rank at the
We ran out of people. And then we
bottom of the order.
All right.
They
Guys,
didn't trust you going solo either. They had to like,
Yeah, I need training wheels.
training wealth. AP is here. We know it's going to be okay. Adam Parker is one of the fan favorites on the show. Let's do your intro first. Adam is the CEO and founder of Trivariate Research. Prior to Trivariate Research, Adam was the founder and lead portfolio manager of Trivariate Capital, an equity long-short hedge fund. Adam is also an investment advisor board member for Rob's firm, New Edge Wealth. That around. When did you guys first meet?
A few years ago.
All right. and making his first appearance on the Compound and Friends. I'm so excited about this. Rob Sechin is the CEO, managing partner, and co-founder of New Edge Wealth and co-managing partner of New Edge Capital Group. Rob was an advisor at Morgan Stanley, a director at Lehman Brothers. It was not his fault. And a director at UBS prior to founding New Edge. He has been recognized by both Barron's and Forbes as a top 100 financial advisor. Give it up for Adam and Rob. Welcome to the show, guys. All right. Question one. No, I'm kidding. We have to start, guys. We have to start with software. There was another blow up overnight and into today in ServiceNow. This seems to be like a recurring nightmare where every week it's another, or every month it's 1, 2, 3 of these stocks. They're already in 50% drawdowns, and then they report what looked like a good quarter on the surface, and they go even lower. Is there an end? Start there. Is there an end in sight? What do you think?
Do you want me to go or do you want to go?
It's up to you. I'll start. I mean, I'm not ready to call a bottom in the group, but certainly there's a lot of value being created. It's oversold. We've owned a lot of positions. As you know, we owned Adobe at one point in time. We keep trying to rotate into the higher quality names, so maybe we can participate if there is a turnaround. But it seems like these stocks are guilty until proven innocent, and this trend of short software, long semis is going to be in place for as long as it's in place. You look at what More Capital always says, every now and then, Louis Bacon, something comes along and knocks you into a different atmosphere. Something came along and knocked them into a different atmosphere, and it's not changing. And it may not be changing for a while, but that doesn't mean that value is not unlocked at some point in the future in the form of earnings that sustain.
You know, it's a good sign. I want to call Fidelity and ask them if they could hide my software positions from me so that when I log in, I don't have to look at them. I already know they're down.
I have a view on this.
Yeah.
And
I assumed you did. I
want to be kind of like, I feel like I start all my meetings recently with like everything I'm saying could be wrong. Well, just because it feels like the uncertainty is more than normal. Yeah. So like, I feel like I got to bookend my comments, but like, and we've had some pretty bad calls this year, I'd say, at the sector level. I'm just saying, I'm pretty honest about that. Like, we've had some good calls and bad. We've been recommending healthcare. That's been crap. Like, I could go through it, but we've been seeing the ball clearly on software. It's a good call we've had. And our call has been, when the multiples contract like they have, what comes next is they miss on earnings, and then eventually they miss on sales. And so I'm not surprised on Now at all. It's one of the ones that people love and defend the most. And the reason I think these companies are going to miss on earnings is because the analysts have 80% gross margin and the same net margin every year going forward, 27, 28, 29 in their models. And how are they going to attach all the AI tools that their customers need without some spending? And if you're a JP Morgan CTO or Morgan Stanley CTO, you're going to pressure them on pricing eventually because you're going to realize, well, wait, guys, we can attach our own tools. We have a massive organization. So there may be value gets unlocked, but I think some of the names, but I think what's going on is they miss first on earnings, and then eventually they miss on sales. And what the analysts are so used to doing is saying, I'm calling my CTO contacts. They're telling me they're never getting rid of Now. I call the IR guy. We think it's a SaaS apocalypse. We cry in our beer together. And none of that's what's going on. It's not about today's fundamentals. It's about the distribution of outcome in 2030 fundamentals. So some will work and some won't, but the median software company is going to be bad.
So UBS finally last week came out and said it's not the bottom, and here's why. We talked to CTOs, and they're all using the same term, cost containment. Yeah. None of them are going to accept this automatic roll.
Right, they're going to pressure pricing. Right.
But how much of the earnings power of the software group for the last few years has just been like, we are indispensable. We are the system of record for these customers. They can't get rid of us. We also have the ability to raise prices, and nobody does shit. And now it's not so automatic.
I think that's right. And I think the other thing is, like, when it comes to software selection, kind of maybe perversely, the ones you want to buy are the expensive ones. You don't want to buy cheap software.
I heard you saying that. Could you explain what you mean by that?
If you take this premise that, like, maybe we all know individuals are idiots, but the market collectively is smart, right? When you get stocks that get cheap, on average, they're cheap for a reason, which is the probability they're disrupted is higher, right? So the ones that are more expensive, the security software, Cadence and Synopsys, like, they're more expensive for a reason, which is their technological obsolescence risk is lower. And so when you go back and study like what works in the rebound, it's not the slow growing ones that are cheaper, it's the fast growing ones. So some of these are going to work. I kind of view it a little bit like a lot of software is going to turn into like, you know how like a company wants to fire 1 million people, so they hire McKinsey, and McKinsey says you should fire 1 million people, and then they fire 1 million people, and they say, yeah, the experts told to do it. Right. Some software is going to turn to that, right? Because imagine you're at you're at New Edge, and you're like, I Claude coded some security, Rob, let's implement it, right? Yeah. And then somehow there's a breach of all the advisors, like you're fired, and he's probably fired for being a dipshit for listening to. So you're just gonna pay CrowdStrike or Palo Alto or whatever, just because you have to have an expert in case something goes wrong. Like you may get some of that happening in software for sure, but the ones that are more expensive for a reason, and that reason is they're less likely to get disrupted.
It's got to be hard because I know you're Claude coding your face off. I know your team is like my team, like every firm. The people that are involved with tech are going crazy right now at every company in America. It's hard to then look at the board and look at stock prices and be like, I want to fade this.
I'm close with a number of his employees, and one of his guys who's a stock picker comes to a lot of our events, and he won the best stock picker at our main event last year and has crushed it in tech and
all technology based.
He has
I mean, he
hope he listens to this. Give him a shout out.
So Jay is his name.
Yeah,
He's unbelievably talented.
Yeah.
But we've leveraged tech throughout the start of our ecosystem. It was a tech-enabled solutions firm. We built New Edge on top of institutional grade infrastructure. We didn't start it out of a private bank. It wasn't an idea in my basement. It wasn't built upon my practice. It was built on infrastructure, on rails. And that infrastructure allowed us to bring in technology, plug and play different things, and try them religiously. We rolled out Claude Enterprise to everybody a month ago. So we're trying to be on the front edge of kind of everything we do. In portfolio management, we have a very quantitative approach. You know, I slept at a Holiday Inn last night when I go on TV because the reality of it is we're sometimes reverse engineering the story out of the math.
Right.
That drives the positioning that we're going into, and you can see a lot of these things. But I am amazed. It's like I have 15 analysts working for me at my fingertips. So when I was a banker back in the days at Morgan Stanley and doing analysis, some MD would come to me that we'd iterate, and then I'd go back to him 2 days later. I am doing that same thing. We're working on an acquisition right now, several. And I'm doing that same thing, and it's instant feedback. So you can kind of interact.
You know, you just make me think about. He's probably like me, where like I just have too many interns, right? Because I say yes, like can my daughter, can my nephew,
I know the feeling.
The problem is like they don't have any skill. It used to be I'd be like, hey, go tell me all the acquisitions Microsoft made in the last 5 years and summarize what technologies they're buying. And
now they do.
I'll give 2 seconds and go back. So I don't know what they can do for the other 9 days and 9 hours and 48
Intern
minutes.
fans the machine.
I would tell you that the intern now, the average is going to be good to great, and the great is going to be game-changing for the enterprise. I just can see efficiency happening all over the place. So while we might not lay anybody off as a result of this, I can tell you our pace of hiring will slowly slow.
I'm hearing this everywhere.
And then ultimately profitability is going to explode as a result of productivity. And I think that's endemic
so here's
in the market.
So here's the problem then. So then here's the problem. You have, I don't know what it is, 150, 200 enterprise SaaS companies in the public markets.
Yep.
Forget about pricing, because no one's going to be able to pull off a big enough increase. The real problem is most of these companies are selling by headcount. And what we're all saying here is headcount may not shrink, but it ain't going to grow to the extent that it used to anywhere.
I'd like to know his view on that, because the reality of it is what does that mean for profitability for these companies if they still have essential kind of infrastructure and tools? Doesn't that ultimately make their profitability explode as well? And isn't that a positive thing at some point? And so should we just watch the earnings?
Wait, hold on. We have charts for this. John, so ironically, throw up chart 5. So ServiceNow report this morning down 18%, not bad. We have their headcount by department.
It was my final trade 2 days ago,
you
or yesterday.
dumb
Did you see the earnings? Have you learned nothing from me?
I do it all the time.
Yeah, we've all been there. Q1 2025, 26,698 employees. Q1 2026, 29,732. John, go to the next chart. Their stock-based comp is exploding. Like have they not gotten the memo at all that the street does not like this? Look at that.
So
it's breaking out.
SBC didn't matter until it really mattered.
Stock-based compensation is now we're going down like the twig, down the branch, down the tree, but like it's just a beta factor. So when tech outperforms, the ones with lots of stock-based comp outperform. When underperforms, the ones with lots of underperform. So it's just a beta factor because it's like an R&D intensity factor. But you could have died on that hill. You would have lost a lot of money on the stock-based comp hill over the last 15 years. So you got to manage risk around it. But like I kind of agree with Rob's point, or big time I agree with it. Like it's about productivity. And the question is like, what's in the price? Look at Walmart maybe as the ultimate poster child. Like what would make the market go parabolically higher? One of the things would be Walmart gets on. It says in 2030 we'll have less employees than we have now.
Right. Which might actually end up being the case.
It might, and there's a reason it trades at whatever 38 times forward earnings. It's not because they have 3.5% net margin or whatever the number is now. It's because you're in the price is 5 or 6 eventually. Like they're going to nail predicting how many jugs of milk are in every.
I think that's too early. Is his point? We are at the tip of the spear for these companies figuring out whether they can make that migration, figuring out the implications for the business. You guys probably are too. We are too. We're learning as we go, and we're learning at a pace that I've never seen before.
Gee, I wonder why Wall Street hates why the country hates Wall Street. You just said what would make Walmart really go parabolic if they come out and say by 2030 we're gonna have less employees.
So economists and stock people have never been more incongruous. Like if you, I remember when I was at Morgan Stanley, our economists would say stuff like, I want capital spending and I want hiring. And I'm thinking, if I own a stock and they announce either of those two things, I'm selling it immediately, right? Like there's a giant disconnect between.
That doesn't sound good.
Right. Like I don't want hiring at my company.
Well,
like
it's more potential customers with higher paychecks.
Yeah, that's all bad.
Is one.
More healthcare, more right.
Right.
Like, but so the GDP and the economy are kind of different than picking stocks, right? I mean, look, you had a guest on last week or the week before, a personal friend and favorite
Encore.
of mine, Encore Crawford.
Do you know 70,000 people and counting have watched that episode? She is such a star.
I know her for a really long time.
I met her through you.
And you skipped a couple things about her in her bio. One of which is she has a PhD from Stanford, and the other is she has the number one performing growth fund in the last 12 months in the entire of all growth managers.
All right, but
I told her after, like, you need to
She's
write
very
props.
modest.
But she said something that is totally awesome. Okay, and I've stolen it from her for the last week, which is people who are like bearish on AI don't get it. Like they if you think like it's a bubble and it's over.
Nonsense. She said it's nonsense.
Yeah, and everything sounds smarter when she says it for sure.
Right.
But like I just feel like we're on the precipice of this. Like the reason there's earning estimates that are 18% for the S&P this year and 17 next year and 43 in tech this year and 25 in next year is because you're like in the we might be in the fifth inning of the stocks, but we're in the first inning of like hitting the numbers.
You think that's why small caps are breaking out? Part of the reason?
Yeah, maybe.
You know that the S&P 493, so NOMAG 7, earnings are supposed to be up let's call it 16%. There's got to be some AI productivity in there.
There's got to be.
Has to be.
There's got to be.
Why else would that happen?
No, there is.
It's not 8% GDP growth.
But there is underlying economic strength, right? There, you can definitely, just if you look at the price action of just about everything, whether it be spreads, it is telling you that there is a miss between positioning and what's happening in the underlying economy. I don't think there's anybody better at reading the tea leaves than Tom Lee. I think we could all agree that this is the best data guy out there. Tom Lee sees around corners. It's freaking unbelievable. And how does he see around corners? He's watching these cross-asset movements, right? And one thing that scared me, you might have said it on your show, is he kind of thinks there's going to be this like mid-year pullback that scares the shit out of everybody.
Test the new Fed chair at some point.
Yeah. So, and
meaning if
I don't know
Wash
why
says something that the market doesn't expect, there'll be a big overreaction.
Yeah. Okay. Yeah. So, but when he's looking at these things and seeing what's happening in quality names like the SMEs and what's happening in software, he's listening, and many don't. Yeah. Right? Many get sucked up in the headline narrative of what's happening in the war, and they start to think second and third derivative effects of what could be. But what is it?
Yeah.
Today, what is it?
Yeah, I mean, I think if like the way to think about it might be if the street's got 43% earnings for tech, and yeah, a lot of it's micro and Nvidia, but let's just say it's got 43% growth, and let's say the real number's 30, and it's got 25 next year, and the real number's 15. Tech's not going to be 45% cheaper in a year because it stayed flat for the entire next 12 to 18 months. Like, unless there's a much bigger growth scare coming in 28 or 29 or something, but like the odds are just the absolute level of growth is high enough that things work. And so I think the market woke up to that a few weeks ago. But like, where could people be complacent? Like, I did a big risk dinner this week with a bunch of risk officers, and like,
excited.
Nobody thinks. Yeah, it's not exactly.
Rob wasn't invited to that.
No,
okay.
Rob,
I wasn't either.
Yeah, Rob, not his crew. But like
annual value at risk dinner.
What people are like, if you say what are people complacent about, it's probably that everybody thinks oil eventually is going to come lower and probably faster. So like right now, nobody's taking their numbers down for input costs in industrials or for select energy sensitive consumer, because they just think, second derivative Hormuz news is positive. If I get bad Hormuz news, market's down 40 bips. If I get good, it's up 150. So like, whatever. It's
nobody wants to look like an asshole again.
Right,
for going risk off.
You call it 17 the last zero, like tariff problem. People are a little bit, so I'm not saying that's going to happen, but I just think people are playing for, so like on the Fed, like I'm not sure cutting rates is going to be bullish for multiples like it was 3 years ago.
Frankly, how can it even happen? It creates an inflation expectation problem that is going to be pretty dramatic, I think. It's why you have to own some energy in the portfolios. It's kind of like a tail hedge to this.
Do you think most market participants would prefer the price of gasoline go back to 3 and change versus another 25 basis point rate cut? I do.
I do too.
Yeah, for sure.
Yeah. No doubt.
Well, there's a higher likelihood of that, to Rob's point.
But also, like, it depends where you're on the cycle. Like, when it was the end of 2022, and you perfectly covered your NVIDIA, Tesla, and Meta shorts, which are all down 65%, and you started buying them max long on Jan 1,
Right.
your logic...
Actually, it was December. That
Okay,
I bought
you gotta
mine.
get the positions in. You're big, you run a lot, you gotta
Straight
get them in. Okay, so then your logic was, well, the Fed's closer to the end of the hiking cycle than the beginning, eventual accommodation's coming, the Fed action's gonna be super bullish for multiples, nailed it, right? But the question is now 3+ years later, if they get incrementally dovish, is that really like, oh, awesome, or is it because like stuff's slowing and therefore like at some point...
Yeah, it becomes a growth scheme.
Yeah, it's a little bit different, right?
I'd rather have the gas price come down. Is the semiconductor rally the most out of control thing you've ever seen?
No.
It's not?
I think it's justified too.
Is it the most out of control? I've seen a lot of
I think it's so completely out of control, the pace of it and the relentlessness.
Micron is bigger than Johnson & Johnson.
Okay, so look, I'm a you know, I used to
hold on.
analyst.
Last 16 days, 35% for the semis. 16 days. It is the best rolling 16-day. I know it's a random number. Best rolling 16-day period in the history of the SMH. Never before.
Yeah.
And I understand the reasons. I don't live in a cave, but
I mean,
people will just buy anything semi-related.
I think when you look at semis and you look at tech, you really have to look at it like even software. Look at software ex Microsoft and with Microsoft. When you look at semis, you know your tech book is going to look like it grows more slowly and is more expensive than the tech index, unless you're overweight Micron, because Micron trades at 4.5 times next year's earnings and is growing like 100%. Right? So you know we know it's cyclical, but
you got to see something that comes along and challenges that probability of that outcome. And I don't know
them earning enough.
Right. That is right. And as long as
I don't know what that thing is.
It's hard to see right now. But you know, the pianos don't hit you in the face; they hit you in the back of the head.
NVIDIA has grown earnings substantially in each of the last 4 quarters. Stock has not gone up.
I think the stock will go up and go up a lot.
I know, but I'm saying two things can be true. Yeah. You can have a stock price that just refuses to go along with incredible fundamental news, which is all we've ever seen.
Micron's estimates, plus or minus, I don't know if somebody can. I'm sure somebody will comment on this, but like they were roughly $50 in earnings per share for next year before they reported, and they're roughly 100 now.
Yeah, it's
right. So
unbelievable.
the magnitude. One of the things we're doing right now, we're researching is look at all the companies where 2 years earlier the analyst estimates were most off, like ever on earnings.
Is this high on the list?
And those are the best stocks.
And this guy, in both directions. Look at the ones where they way off too high too, just to see if there's a pattern. But like this is one of the bigger free cash flow estimate misses ever in 25 years in the market. So when you say it's crazy, like the price action's massive, but it's also one of the crazier.
It's crazy because it's such a huge change and nobody knew it was coming.
Like rough order of magnitude, people had like $1.5 billion in free cash flow for next year, and it was like $3.5 billion over 2 years, and now it's $80 billion over the 2. Like the magnitude is like zeros off.
Yeah.
I want to do one last thing on software before we leave that. So you have a lot of hedge fund customers. I'm imagining that nobody wants to touch software, although I'm sure there's a lot of dip buyers that got their hand burned. But ServiceNow, for example, so they report this number of customers with $5 million ACV. John, chart 3, please. And they went from 434 customers paying $5 million up to 630 in Q1 with a 97% retention ratio. Now, their margins came down, but this is still a good business.
100%.
The problem is nobody
sits on the macro. I mean, you're going to have to manage all this.
But the stock is down 18% today.
Isn't that scary? They did 22% revenue growth. They hit the numbers, and the stock still lost 20% of its value after being down 50-something%. Isn't that scary?
So when you talk to your clients, like, what's their view? Is everybody like, this is uninvestable? How do I buy this?
So the only thing I'd parse into what you asked me is I think it really depends if you're long only or a hedge fund, right? Most hedge fund money, like they don't have to own any of this stuff.
Let's do long only.
Or they can pair off, right? So it's really more the long only guy who's, you know, is what he is. He's a software analyst. Like, why does GM make cars? Like, you know, like the software analyst, he's got to pick winners and losers in the group and identify how to like outperform the software benchmark, right? And the PM's job is to figure out what exposure to the aggregate group should be. So I think most analysts are going to say, I want to own stuff where the revenue is accelerating. And, you know, if you look at a 2x2 grid of like, you know, beat on revenue, beat on earnings, missed on rev. The worst bucket is what now reported, which is you fine on revenue and you miss on earnings because the market doesn't know where the clearing margins are, but you just expose the fact that like your margins in the out year are lower.
And margins came down. Their guidance for margins came down.
So it's not trading 18% lower today. It might be trading 4% lower on 2030. Like you have to warm yourself up to that idea of like the uncertainty on the margin profile just changed. There are assets, including now could be one of them, and I'm just not smart enough to know that this could be like a great entry point in a 2 or 3 year. But I need to see some price action that we all know are going to shake our head yes, where a company misses it doesn't.
What does that go down?
That's it.
I haven't seen a single.
The stock doesn't move.
I haven't seen a single penalty for missing that hasn't been harsh. Right. Today was the first day where I thought a couple beatings were good. URI, Texas Instruments up massive. And, you know, but if we track this thing, the penalty for missing versus reward for beating ratio, and not only has it been very skewed toward the penalty harsher, but it's like cheap stocks missing are going down more than expensive stocks that are missing.
So what type of market does that happen in?
A toppy market.
Like, yeah, I think the good news, I guess, is more companies are beating than missing. So that's why the market's fine. But like, if more companies start missing, like we can't buy stuff where we don't have any evidence. Like the best thing ever is like, the old days, like Caterpillar misses and it's unch, and you're like, all right, game on. Like I mean, missing is unch.
Missing.
Yeah, but we're not seeing it. Missing's annihilated, right? Yeah.
Put this tech multiple compression chart up. This is a thing. What do you guys make? What do you guys make of this? I think it's 7. Yeah, here we go. So let me narrate this for the people that are listening, not watching. We're starting in 2020, right around COVID time. We were at 16 times for tech's forward PE ratio. Peak out in the 2021 bubble at 28.7. Fall to a low of 18.5 during the year of efficiency, 2022. Then we rally through 2024. We hit an all-time in this chart, 32 times forward earnings. Drops early 2025 to 21. Back to 31 at the end of 2025, one of the best years ever. And now here we sit at 19. Huge derating on forward earnings.
Very quickly.
Very fast. Very unexpected. I don't remember reading any strategists saying...
Micron's estimates are up 100%. I mean...
Is that all this is? Is the growth rate growing faster than...
If the estimates are for 43% growth in earnings this year, then that you can have multiple being high because the E went down or because the E was nuts and the P went up. And in this case, it's more
the E is going up really fast and pricing is...
I'll give you one nugget. If you look at the S&P 500, the whole 500, Q1 26 versus Q1 25, year-over-year growth, 45% of the entire S&P 500's growth was from Micron and NVIDIA.
If you believe this geopolitical risk leads to slower economic trajectory, markets are going to pay up for that growth, and you're going to see that go right back up.
Because if there are less companies growing, they'll go right back to the old playbook.
Or just the E. If the E comes in and it's unch on multiple, the stocks will be 40% higher. Like, or Micron will be up, or whatever. So it's a multivariable world, and you just showed one variable or whatever the criticism is.
What were you telling client? What did you make of the stair step lower during the war? The fact that the market just wouldn't puke. What was that telling you? I know it's hindsight now, but
it made me more bullish.
Same.
Yeah.
We didn't have a panic. We went lower.
I came into the year.
So that's actually what kept us invested completely through that. Now we did upgrade quality. Like I said, when you get any volatility, it's a great opportunity to kind of pivot to a higher quality name in the same sector that's not getting derated as much or has shown more resilience in their earnings.
You say, wait a minute, we can now own this.
Yeah, especially if you're a long only relative investor in a certain class, whether that be dividends, value, growth, and you're kind of managing to a benchmark in a portfolio construct, and you can say, okay, now I can own this. I could never own this. I mean, for so long, we never owned NVIDIA until it traded below 30 times earnings. We waited it and we missed a lot in doing that, but boy, did we buy it at the right time. And it's been, so if you can still employ your discipline, and when volatility creates the opportunity to upgrade quality and you can move from X to Y, you do it. And that leads to a lot of outperformance.
Volatility, though, to your point, within a reasonable
band.
Like not a free fall where all of a sudden it's like, wait a minute.
That's that whole different atmosphere thing.
We
didn't get that this year.
And you won't get it from geopolitical. You get those from financial issues, right? So this credit issue that we kind of, I don't really believe, I know a lot of people do, but I've been an ardent defender of the equity that sits beneath it and the economy being strong enough that these private equity firms are not walking away from these businesses and the credit's going to be fine. And the market's kind of telling you a little more, at least the more public markets, that spreads are remaining contained. And listen, a lot of the credit in private credit sits at the highest tier of the capital stack. So you got to wipe out a lot before they're wiped out, right?
Yeah.
So from my lens, it is that is more of a concern than anything, because that's the liquidity that feeds the ecosystem that we all thrive off of.
Financial conditions.
Now, I will say that if you cannot raise money going forward, we talked about this on the other show. The reality of it is if your forward ability to raise capital from private investors has been impaired, and that was your growth strategy, right?
Yeah, toast.
And though they're not coming back right away, but the institutions are staying in because they see the value of this. You're going to be more discerning because you have to be, because you don't have as much capital. And so the strong are going to get stronger. They're going to get financed. And the weak are going to require more investment. And some of them will get it.
Buy KKR
and some
or
of them
something.
won't.
Maybe buy some KKR.
I've thought about those stocks.
Look at this. So Blackstone.
Yeah, no.
Yeah.
I mean, maybe Blackstone. I meant,
So
I didn't know which one you're going to show. But
Blackstone
Yeah,
reported
so
today.
I tax loss sold, not me, the team. Tax loss sold Blackstone. I got a lot of shit on it on the show because I was such a champion of these things. But it was just tax loss.
So you bought something else?
We didn't buy something else in the space, but we would likely go back in to Blackstone.
All right, so Blackstone got whacked off today. It's down 6%. And this is the private credit fundraising on a gross basis by quarter.
Mm-hmm.
Okay? down almost in half, not quite, 3.3 billion in the prior quarter, down to 1.9 billion. This is gross, not net. Okay, so I don't think there are outflows. So a dramatic slowing. But not to
think
zero.
about this.
This is the media narrative pausing people who are about to allocate.
100%.
Of course, I mean,
and it's
it happens
also
all the time.
human nature in advisors. We're advisors to say, hey, do I want to try to take advantage of this and steer into the eye of the storm? Most people don't do that. Most investors, the success that we've had as a company, period, is identifying areas where forward returns are headed higher.
But pricing has not come down.
Right, we're not even in a storm.
Yeah.
It's a slow storm. That's it.
So that's right. But let's use a different example in when we had the tech crisis and in venture companies having trouble raising money and it re-rated down and they pivoted to venture debt. There was an enormous opportunity in venture debt because they didn't want to sell equity at those levels. And if you steered into that storm just in a different way, right, what it led to is higher forward returns. And you see that episodically in markets. So I think one of the great challenges that advisors have is keeping investors invested, and how you do it is by identifying the high optionality within the underlying crisis.
Right.
That will have a greater probability of success on the other side.
If I read a headline that said 6 months from now, great news, or it would say horrible news, all of these leveraged loans are now trading 20% cheaper than where they were. The thrust of that article would be written as a way to bash the private credit industry.
Go right in.
But then I would say, I love it. I haven't bought any of this shit yet. This is my opportunity.
100%.
I agree with you. I don't think most people think that way, number one. And for financial advisors in particular, what do you think most of their clients would say back to them? Hey, let's buy some of this asset class that the Wall Street Journal is screaming bloody murder over on the cover of the newspaper. Why would we want to do that? That sounds crazy.
And I would say, did you see Blackstone's partners step in to buy, take a gigantic chunk of their own money and buy this? You think they're doing that because they have massive concerns about the asset class?
So KKR just bought $10 million a stock. That's why I mentioned KKR. I didn't know the Blackstone, but I saw they bought.
My
the
son
pushback I got was somebody was like, "Yeah, well, guys, you got $1 billion." I'm like, "Yeah, but people don't like throw $10 million out on purpose. Like, the person's signaling purchase."
But right now, the price with a few obvious examples, it's not like that leveraged loan market is in distress. It isn't. It's not like there are these massive discounts.
But the narrative gets sucked in and pushed out so quickly.
I think I like the equities better than the products. Would be my comment.
For sure.
I like the equities better. I'd rather be a GP. If I could buy KKR and Blackstone,
I got like pissed a year ago from somebody on a private credit product, and I was looking at it. It was like unlevered 13% private credit return, and I was like, sorry, I don't want to be like the annoying client. But who's lending to me at 13% unlevered? Because like, what is this? Is it like nail salons in Orange County? Like, who needs 13% from me? Like this math doesn't make sense. So like the stocks are probably a 2-year view, better.
But the stocks are cut in half. The private credit's still trading 1 for 1.
That's my point. Right. You're not getting a discount in the underlying. You sure are getting a discount if you come in at the GP level, buy the stocks. Yeah. So, all right, you want to do this chart with the highs?
Yeah. So part of the narrative over the last couple of weeks is, we're hitting all-time highs, which is awesome. Feels good. Feels better than being down. Mm-hmm. But there's not a ton of stocks making 52-week highs. So this chart is from Jason Gepford, sentiment trader. So he's looking at the S&P 500 return after the first record, it's specific, but whatever, after the first record high in 1 month, and under 5% of issues are at a 52-week high. That's kind of odd, under 5%. And it's a mixed bag to down. It's not great. Yep. Positive 33% of the time, 1 month out, 33% of the time, 2 month out, 42% of the time, 3 month out, 6 month out. I mean, these are not great numbers. And it's not like one time. This happened, in 29, all right, 83, 90, 93, 95, 2000, 15, and 20.
Do you want me to shit on this? Or
yeah, please.
Go ahead.
Please.
Okay. I'll just start by saying I don't think this kind of stuff is helpful for predicting subsequent return. This is not statistically significant. The market's way more concentrated, different than it used to be. You guys are financial advisors. I'm not, but I can empirically show you that any kind of breadth metrics do not effectively help you make money. They're usually volatility gauges. So if I were one of Rob's advisors or Rob, and somebody said, I'd like to time my market entry here, I would say you will destroy value using this kind of data over your career. Whether it's VIX or moving average convergence versus
you don't like probabilistic forward return studies.
I know this isn't statistically significant. I know it's not it's all like how relevant is the 1929 data to 2026 second half. All you really said is that there's some big stocks that are up a lot. So not all of them are. Okay.
Good debunk. Let's take a quick look.
But I want to just caveat, like, that could work right now. I'm just saying, if you gave me 1,000 of these charts over the next few years, I'll take the under on more than 500.
I actually don't think anybody invests based on that.
No,
I think people use that.
You want to be
justify-
fully invested.